Well, oil analyst Stephen Schork of Schork Group says oil could hit $100 a barrel in the first half of next year. And Steve joins me now. Great to see you right before the new year.
Happy New Year, Betty.
Okay, Steve. So, reading through your reports and your predictions about oil, I've got to wonder, though, everyone, or not everyone, but most people are calling for a rebound in the dollar. Given that scenario, could oil really run up as high as you say?
No, absolutely not. A lot of this is predicated on further weakness, Betty, in the dollar. We have to appreciate a lot of what has kept crude oil prices high for the second half of 2009 has been, shall we say, irrational exuberance from the Wall Street touts. Because if we listen to the industry, and let's just say Petrobras, the state-owned oil company of Brazil, they'll tell you they're happy with oil at $55 a barrel. Hey, I believe them. These are the guys who have the capex. These are the guys that have to pull the oil out of the barrel. But as I tell my daily subscribers, you know what? Perception, or Wall Street, that is, usually trumps the fundamentals at this point. So that is key in the first 6 months, Betty, of 2010, is the value of the dollar, because it's been a great carry trade. Sell those weak dollars, buy those hard assets. But if you don't get further weakness in the dollar, I think the floor from crude oil could fall out.
But where do you stand on that, Steve? I'm trying to figure out where you stand on that. You do believe in a weaker...
First of all, I believe in lower oil prices. I am fundamentally, from a very bearish standpoint, from a very simple standpoint, Betty, refiners, oil refiners, the guys that actually buy crude oil, they can't make any money with that crude oil because the margins, what they sell that crude oil in, gasoline, distillate fuel, they can't make any money doing this. So therefore, you've got big refiners like Valero shutting down their Delaware City. You've got refiners ConocoPhillips, Sunoco, all shutting in production because these guys can't make any money with crude oil at this high. So this obviously tells me crude oil at 75, 85 dollars a barrel is too expensive.
Okay,
so,
then where does your $100 forecast come from then?
Well, the $100, let's the $100. That's not my forecast. The $100 is a probability model that suggests, based on where the implied volatilities are trading, is that the expected range for 2010 ranges in between the low 60s and the high 90s up to $100. So there is a theoretical probabilistic event out there that could propel oil prices to $100. But I am more of the camp that I think oil prices belong more towards $60 rather than $100.
So you would not, so somebody listening to this report then, I mean, you would recommend that you not buy oil even if those statistics, if those models tell you that we could be headed to $100 oil? Because you're saying the downside is greater than the upside. Is that what you're saying?
The best possible advice I can give at this point is not to do anything. Oil has been in a range between the low 80s and the high 60s since July. So we've been the better part of the year in between that range. I don't want to own oil at $70 a barrel. I don't want to sell it at $70 a barrel. But if oil breaks through the mid-80s, then that tells me that there is a trend and we are going towards, or the trend is towards $100. I'd be more interested, Betty, in owning $85 oil than $75 oil. Conversely, I don't want to sell $70 oil, but if we break this range in the mid-low 60s, then I'd be interested in selling at that point, because that, again, is a sign to me that the trend, the range has been broken. But at this standpoint, Betty, oil in the high 60s, oil in the low 80s, it's a do-nothing proposition. We're just simply range-bound.
Okay, well, that could be easy for some people to do. Do nothing on oil right now. Okay, Steve, thanks so much. Stephen Schork of the Schork Group talking about crude oil.